Welcome everyone to today's presentation on mobile home parks and related investments. My name is Jack Martin. I'm the co-founder of 5210. Before we get started, quick disclaimer. This is not an offering to sell securities or an invitation to invest. Before you do so, make sure to get all of your questions answered and read offering documents in their entirety. Goal of today's presentation is to provide an education about mobile home parks, share what the opportunities look like at 5210. And even if you choose not to invest with us, I'd like each of you to leave with perspective around what investors should be looking for when evaluating an investment of this type. A little bit about 5210 and our origin story. That's me on the left, and that's Nate Petty on the right. Both of us grew up in the Midwest. Nate's an Indiana boy. His parents were school teachers. And on the side, they had a portfolio of rental properties. So he grew up in the business, changing out hot water heaters and reconditioning units. I grew up in Minnesota in an extremely large family with 17 children. So I learned pretty quick that if I wanted something greater than what my parents' budget could accommodate, I had to go earn it myself. So both of us grew up in that working class culture with strong Midwestern values. And I share that because I believe the most important thing to get right when you're investing in something of this nature is the people. So if you're watching this today, you probably don't know us, but as you get to know us, you'll find what over 200 investors have discovered, which is those Midwestern values are at the core of everything that we do here at 5210 on a day-to-day basis. So lesson number one, get the people right. A little bit about the origin story. When Nate and I were architecting 5210, we were looking back to the crash of 2008 to see what investment survived and what performed the best. And there was one investment that clearly stood out. It weathered the storm through the great financial crisis better than anything else. It outperformed all other real estate, and it continued to be in high demand even in spite of those difficult economic conditions. And that was mobile home parks. So we elected to build a business around mobile home parks because we and our investors want to weather the storm the next time an event like 2008 occurs. We'd like to outperform other real estate, and we want to continue to be in demand through all market cycles. So what you'll discover as we walk through this presentation is that mobile home parks are considered to be a lower risk asset. So if you look at this simple demonstration of risk, where the higher to the right you go, the greater the risk, and the lower down and to the left you go, the lower the risk. This becomes a conversation about the potential for loss, but also how severe that loss could be. So if we experience another event like the Great Financial Crisis, and you own assets that are up to the right, the potential for loss is higher, but also you could lose all of your capital. But as you move down to the left, um, the potential for loss is lower, and then the severity of loss also gets lower. So again, as we walk through this, it will become clear why mobile home parks are considered to be a lower risk asset. So let's walk through what we're going to cover in the presentation. First, a brief overview of mobile home parks and what they are, what makes mobile home parks unique, and then how does that translate into their ability to perform better than other real estate. Where the opportunity is, both on a macro sense, but also drill down into the type of properties that we seek to acquire. We'll talk about a few things that we do different here at 5210, and this will shine a light on some of those things that investors should be looking for when they're evaluating an investment of this type. We'll briefly cover the offering types that you can expect to see at 5210. And then we'll wrap up with a conversation about bonus depreciation on the tax benefit side. Let's start with a brief overview of mobile home parks and what they are. The simplest way to describe a mobile home park is if you can imagine a giant parking lot where instead of parking a car in each one of the parking spaces, you park a home in each one of the parking spaces. So if you see in this aerial photo, each one of these homes sits on a rectangular lot. Mobile home park spaces are also called mobile home park lots. Here's an example of a mobile home in one of our parks. The tenant owns the home, so they do all the maintenance, all the repairs on the home. They also take care of the landscaping on their individual lot. And because we own the land, they pay us a monthly lot rental fee for the use of the parking space that their home sits on. So as the park owner, our responsibility is to take care of things like the clubhouse, the pool, spa, all the common amenities like barbecue areas and fire pits. Some of our parks have laundry facilities, game rooms, sport courts, and then of course the park owner's responsibility is to take care of the road. So the pavement needs to be kept up nice, and all of the common area landscaping is our responsibility as well. But the tenants, that every home that you see in the background here, the tenants own those homes. So those all the maintenance and repairs associated with the homes themselves are cared for by the tenant who owns the home. Let's explore what makes mobile home parks so unique. The first thing that stands out about mobile home parks is it's the most affordable housing by quite a wide margin. So the next most affordable option is twice as expensive as living in a mobile home park. This creates constant high demand. So this is both in a strong economy when things are expensive, but it's also during a recession or when things get difficult. So when people start tightening up their belts, it's not uncommon for someone who lives in an apartment to move into a mobile home park because they're seeking a more affordable option. So it's really important to recognize that A, it's the most affordable housing by a wide margin, and B, that affordability creates constant high demand. So in other housing, you see booms and busts, but in mobile home parks, you see constant demand. So it's a very stable asset class by nature. The second unique thing about mobile home parks is the fact that the tenants own their own home. So there's no other real estate where the tenant owns their home, they do all the repair and maintenance on their home, but yet they pay a monthly rental fee for the lot that their home sits on. This creates more of a homeowner mindset versus a renter mindset, and I'll explain here. In a traditional housing, like an apartment or rental home, the tenant lives there, but they're really looking at that through a lens of a temporary housing solution. If anything changes in their life, it's easy for them to move. All it takes is a few friends and a pickup truck and a weekend. Whereas in the mobile home park space, when someone chooses to live in a mobile home park, they're making a permanent housing solution. They're purchasing a home. It's not just a rental, it's an actual home purchase. So it's their intention to be part of the community and stay there a long time. So this is what creates what's called sticky tenants, and they rarely move out. So if you think about the most expensive event that occurs from the owner's perspective of rental real estate, it's when a tenant moves out. So you have this process of turnover where you have no rent coming in while the unit is vacant. You also have the expense of reconditioning the unit and doing all the repairs from the previous tenant. And then you have the cost and time to spend seeking a new tenant. Whereas in the mobile home park space, because these are homeowners and they think like homeowners, when they make a decision to move, it's not just on a whim. That's a serious decision. And if they do choose to move out, they sell their home. So the next buyer that comes in is also making a permanent housing decision. And the experience for the mobile home park owner is last month, the prior homeowner paid the lot rent. And this month, the new homeowner pays the lot rent. So mobile home parks are very unique in this respect that they don't experience the high expense of turnover like other real estate asset classes do. And the third thing that I'll share on this front, and this is something that most people are not aware of, is that the penalty for not paying your rent in a mobile home park is that you lose your home to the park. So this doesn't happen very often because it doesn't make any economic sense. The average lot rent across the United States is probably in the $500 a month range. Homes are worth $100,000 or more. So it wouldn't make any economic sense for someone to skip a $500 lot rent fee to put their $100,000 home at risk. So this home ownership is a very unique dynamic that creates stable income. Lot rent gets paid. It's very simple. And most other real estate asset classes cannot enjoy that same dynamic. So let's summarize what makes mobile home parks unique. The first item that stands out is the constant high demand, and that comes from affordability. So this demand is present in all phases of the economic cycle, irrespective of what's happening in the world around us. The second item that stands out is the fact that the tenants own their own home. So they have a homeowner mindset and they intend to live in the same place for a very long time. So mobile home parks give you the best of both worlds. You have the constant demand of new tenants coming into your property, and then the tenants rarely ever leave. Now let's look at how those unique characteristics of mobile home parks translate to investment performance. The first thing that stands out is the predictability of rent collections, and we only have to look back to COVID for contrast here. So during a time where many other real estate asset classes experience rent collections down 50% or more, we were able to collect the lot rent from our entire portfolio. So if you recall, there was a moratorium in place in most markets during COVID, where you couldn't evict somebody for non-payment of rent. This opened the door for tenants to strategically default on their rent. So they knew they couldn't be evicted for non-payment of rent, so they just simply didn't pay. And then when the moratorium was lifted 6 to 12 months later, then the eviction went through and they simply moved. So, but in the mobile home park arena, this was not the case. So the penalty at the end of the moratorium for non-payment of rent would have been the forfeiture of your home. So the result of that was there was no strategic default in the mobile home park business. So the really unique thing, or these unique characteristics of mobile home parks create predictable rent collections. The second thing that stands out is the greater potential for appreciation. So obviously the value of a property is equal to the number of tenants that are paying rent. So if you're always increasing that and you're filling vacant spaces and bringing in new tenants and they rarely leave, you're constantly able to increase the value of the property. So in the best case scenario, you have the potential for high cash flow and high returns. And then the worst case scenario, you still have stable cash flow and you always have that continued demand that allows you to constantly be executing on your strategy. So it's really important to look at mobile home parks through a different lens because they're a lower risk asset, and there's protection from loss of principal. If we circle back to earlier slide, and this is the reason why we chose mobile home parks to build a business around, we want to be able to weather the storm when the next GFC kind of event shows up. We'd like to be able to outperform other real estate and always continue to be in high demand. And one last look at this risk slide, you'll see mobile home parks on the bottom left. So as you're evaluating investments, always consider what the risk profile is, and you'll find that mobile home parks deserve to be looked at through quite a bit different lens. Now let's take a look at the opportunity in mobile home parks, and we'll start more globally and then we'll zoom in. First of all, it's no secret that there's a shortage of affordable housing in this country, and that doesn't look to end anytime soon. This is primarily because the high cost of land, labor, and materials make it virtually impossible to build traditional affordable housing. That creates the highest demand in this country's history for affordable housing, and there's really no competition for mobile home parks. So mobile home parks stand out as the only truly affordable housing solution, and it's affordable by a wide margin when you look at entry-level new construction single-family homes versus an entry-level mobile home in a mobile home park. This is all occurring at the same time that we have a shrinking supply of mobile home parks in this country. So over the last several decades, a lot of the locations where older mobile home parks are positioned are prime for redevelopment into something else. So there are more mobile home parks scraped for redevelopment to a different type of construction than there are new mobile home parks being built. And that again is by a wide margin. So as an example, here in Phoenix, where our office is located, there were over a dozen mobile home parks knocked over last year, and there were no new mobile home parks built in the state of Arizona. So that's happening all over the country. There are between 10 and 15 new mobile home parks built each year, but there are hundreds of parks that are knocked over. So again, this favors investors and owners of mobile home parks because this is becoming a scarce asset. The last thing I'll share as it relates to the mobile home park arena is it's a fractured market still, where traditionally the ownership has been more single owners and mom and pop owners. So other asset classes have been consolidated by institutional buyers. And even though that has started to take place in the manufactured housing space, it hasn't happened to the degree that you see it in other asset classes. So there's still a great opportunity for quality assets to be acquired in quality locations before that consolidation is complete. Now let's zoom in and let's look at the specific type of parks that we like to acquire. First of all, larger parks. So there's nothing wrong with smaller parks. There's probably great deals on those as well. But what we found is that you really start to achieve efficiency and economies of scale when you get to 100 lots or more. So we like to seek larger parks. Second thing that stands out is we're very particular about the markets that we go into. And two things here to note. One is that we like to see median home values be higher than the average across the country. So that allows us to have a wider delta between a new manufactured home in our community versus a new single family home in the market around it. So the affordability of a mobile home in a park really stands out in a market where median home values are higher. And the second thing is job growth and population growth. So it doesn't really do us a lot of good to acquire a great deal on an asset in a park where the population is declining. A third thing we look for is parks that are not professionally managed. And this allows us to install our own internal professional management here at 5210 and have an opportunity to really increase the performance. We also look for parks where there's existing cash flow, or at least there's a clear path to a coupon in the early years of ownership. And the last thing we seek is underperformance of some nature that allows us to put our skill set to work and increase both the cash flow and the value of the asset over the course of time. Now let's take a look at the specific underperformance that we're seeking. It's pretty common for us to focus on these things as our initial strategy for every park that we own. First thing is reduce expenses. So having been in the business as long as we have, there's a dozen ways that we can reduce expenses that are common for the prior owner to not have addressed. And then it's pretty common for utilities to be master metered. So unless you go through the process of sub-metering, you can't reimburse those utility expenses. Second thing is vacant park-owned homes. So it's common for us to acquire a park where sometimes there's a handful of park-owned homes that are vacant, and sometimes there's hundreds of them. So we go through the process of renovating them to a really high standard so we can attract a great tenant to purchase that home. Third thing is filling vacant spaces. So probably the most difficult thing to execute on is infill of vacant spaces. So this involves buying a new home directly from the manufacturer, having it set up, having the awning and air conditioning and all of those things installed, and then selling it to a new resident. We'll take both a combination of temporary RV use in markets where that's allowed, so that we can get some income on those vacant spaces. But then in a rolling fashion, we'll bring a dozen homes or so into the marketplace so that we can sell those off and fill those vacant lots. The goal is in every park that we own is to have all of the lots filled with a home that's owned by the tenant. Fourth thing that we like to focus on is capital improvements, and this will be done kind of in a rolling fashion in the background. And really, this is bringing the park back to life. So things like pavement that's bad, lighting, landscaping, common amenities, clubhouse that's really old and dated, security, and those kind of things. And then the final thing is rental rates. So, we'll take a little bit different approach than other operators might take. Even if we buy a property where the rental rates are substantially below the market, we're pretty careful to move those at a measured pace. So our goal is to provide value to the residents that live there at the same time that we're raising rental rates. But then also, if there's a substantial amount of infill that's required, we like to be a little bit behind the market with respect to the lot rent because it makes the initial attraction greater, which allows you to sell homes at a greater pace. Now let's take a look at the things that we do different here at 5210 that other sponsors may not be doing. And this will shine a light on the things that investors should be looking for when evaluating an investment of this type. The first of those is the deal pipeline. So this answers the question, how can investors be confident about deal flow? So would you rather work with a sponsor who's sitting in their uh, 50th floor office in New York, evaluating publicly traded assets and competing with institutional buyers? Or would you prefer to work with a sponsor who's built a great internal deal pipeline and they're looking at deals that are not available publicly for sale? So here at 5210, all of our transactions have taken place off market. So there's a combination of direct to owner assets that we've done, and then also some where there's been a broker involved in some capacity, but all of our transactions are done off market. This requires that we build our own internal database of every park that we'd like to acquire, and have the ability to work directly with owners when it's possible. And then also building a network of brokers. And there's a handful in the marketplace that we've built a great relationship with where they seek to do off-market transactions, but only with buyers that they have a relationship with and that they trust. And this really is built around spending the time required to build quality relationships with owners and brokers so that you can create a great pipeline of deals. The second thing to highlight that we do different here at 5210 is centered around our approach to operations. So this answers the question, how can investors be confident in our ability to run our business and execute the strategy for every park in the portfolio? We use business architecture, commonly referred to as EOS. It stands for the Entrepreneur Operating System. And if you look at the graphic on the right here, I'll just kind of walk through these 6 components. The vision component is centered around everyone on the team being focused at the same vision. And these are long-term, medium-term, and short-term vision. The people component essentially says, let's make sure that we have the right person in the right seat. The data component is focused on collecting the right data and then making sure that each team member has KPIs that they report on a regular basis so that you can see if things are on off track or on track. The issues component would suggest that every company needs to have a clearly defined methodology for identifying issues, for discussing them, and then permanently solving them. So you're not just kicking issues down the road. Processes, even though it's not the funnest part of the business, the truth is if you want to scale your business, you have to establish processes for everything that you do, and then have a system for constantly fine-tuning and improving those processes. And if you'll do all 5 of those components correctly, what you end up with is you have traction in your business and you can scale. This is a goal-oriented business architecture. It includes long-term 10-year goals. It includes medium-term 3-year goals. It also includes short-term 1-year and quarterly goals that allow you to take smaller bites out of the apple in the pursuit of your long-term goals. We had so much success with this at the company level that we chose to install this EOS at every single property that we own. So each property has its own unique long-term, medium-term, and short-term goals, and the team members at each property have unique KPIs associated with the property. So we can keep our thumb on the pulse of whether we're on track or on track in real time at every property that we own. This ensures consistent results, and really the result of this is it gives us the opportunity to overperform our initial projections at every park across the portfolio. The third item to highlight that we do different here at 5210 is what we call transparent investing. So it's easy for investors to get focused on or enamored with the returns they can make, but it's extremely important that investors are confident that they'll get their principal back. So how do we protect investor capital to avoid things like Ponzi schemes? So when you're seeking an investment of this type where you're a passive participant and somebody is managing your capital, you certainly want to avoid the Bernie Madoff experience. You also want to avoid sponsors who are cooking the books or misappropriating funds. And then we have to recognize that we're humans and the potential for human error exists. So what do we do at 5210 to make sure that we and our investors avoid all of this? We use a third-party fund administrator. So we currently use a company out of Michigan called Red Cedar Advisory Services, and the role of the fund administrator is to be the neutral party referee. So they get to report exactly what happened, and they don't have any dog in the race with respect to coloring it any different than what actually happened. They provide a secure investor portal, and they manage all the compliance items, so the risk is taken off the table there. They do the monthly reconciliation of bank accounts to make sure that everything is in the correct chart of accounts and everything is accounted for. And they do the fund level or entity level accounting. They do that for every single property or investment entity that we have. So they get to see, they have a lens into the entire enterprise. So we can't hide anything from them. They get to see the entire business. They offer quarterly transparent reporting, so the investors get to see every transaction that has occurred in their investment account on a quarterly basis, beginning from the day their first dollar landed in the partnership account, along with quarterly P&Ls and balance sheets. They also do the distribution of cash flow, which happens for most of our entities on a quarterly basis. They handle the return of capital and the distribution of profits when properties are refinanced or sold. And then the last item that I'll touch on here is often overlooked. So what happens if both principals at 5210 die in a plane crash? Typically, what would happen is a receiver would be put in place who knows nothing about mobile home parks. So to avoid that and to maximize the experience for the investors, and then of course our families and employees, we've created a succession plan that includes a pre-selected successor GP who runs his business on EOS, just like we do. So he could step in, manage the asset, position them optimally for sale, and then wind down the assets so it would be in the best interest of all parties involved. Let's walk through the experience and track record here at 5210. I'm going to rifle through a bunch of bullet points here. First of all, owned and managed over 1,600 lots. We have both MH and RV experience. You'll find that we don't focus on the acquisition of RV parks any longer, but having that experience is valuable because many times when we buy a value add mobile home park with a lot of vacancy, we are able to lean on that RV experience so that we can have a blended strategy of temporary income from RVs while we're executing on a permanent strategy of infilling those with new homes and permanent residents. We have a track record of overperforming the original projections on every park that we've ever purchased. In full cycle IRRs over 20%, and that's net of fees to LPs. We're vertically integrated across the property management, our maintenance, and CapEx. Now we'll use third-party contractors on larger projects like pavement and those kind of things. We have our own dealer's license, so we're purchasing at cost. We're not paying the markup. We handle all of our home sales in-house, and this is really important because every market requires a different home sale strategy. What works in one market does not necessarily work in all markets, and it's often the case that you have to pivot. So when plan A doesn't work, you have plan B, and having home sales in-house allows you to make those quick pivots. And then we do all of our marketing in-house, and that's across every aspect of the business to attract new residents, to sell homes, to market the park itself, websites, web development, all of those kind of things. Let's walk through the assets that we've owned under the 5210 flag, starting with a few full cycle assets. So the Safford RV Resort was the first park we sold. This is a transient RV park. We purchased this. It was running at about 65% occupancy. Terrible management, a lot of CapEx or unfinished construction. So we finished all that work. We replaced the management, and we got that to run consistently around 95% occupancy. And then we exited in 2020 with a net return to our investors north of 20%. Santa Rita Heights, we'd probably write a book about this park. Small community or rural community. Every horror story that you've heard of in mobile home parks was present here. We had drugs and you name it. We repositioned this one, filled up all the vacant spaces, and sold it in 2021, again with a net return to our investors of north of 20%. Central Park Estates, this is a current Fund One portfolio asset. It's a all-age community in southern Arizona. The OG RV resort, this is more of a permanent park model RV resort. So even though it's a seasonal asset, the tenants who have homes here or permanent RVs here, they pay all year round, whether they are present or not. A little more shot of the street here. You can see that even these are small park models. They're small lots, but a great park, and we own this and operate it in Fund One. Melody Court, also a Fund One portfolio asset. This is a 55 plus mobile home park in Yuma. Palo Verde Hills, this is probably our lowest quality asset, but it's probably one of our greatest cash on cash return assets as well. So we bought this at a nice number. It's on the outskirts of Phoenix. It's a senior 55 plus park, also owned in Fund One. And then Country Breeze was the final park that we purchased for the Fund One portfolio. This is a 162 lot all age community in Yuma, Arizona. Palm Harbor Estates. This was the first asset we acquired for Fund Two. This is currently the largest asset we've purchased. This is a 246 lots. It's also the heaviest lifting asset that we've acquired to date. So when we purchased this, 10% of the lots had tenant-owned homes on them. There was 50 vacant homes there, and there was 50 park-owned rentals there. And then on top of that, there were 120 vacant spaces. So a really heavy lifting project that'll take about 5 years for us to work through. But the goal here is to end up with 246 lots, each one of them with a home on it owned by the resident. Stonehaven, this was our second, and you'll see its sister park, third asset acquired for the Fund Two portfolio. This one was really unique. The same guy owned this phase one, which is a really nice community, and I'll show you another few photos here. But next door to that was phase two. It was mostly developed, but it still needed to be completed. And then across the street, there's a mobile home park that was mostly vacant. I'll walk through a few more photos. This is a really nice quality asset, low density, nice homes, wide streets, sidewalks. Each unit has its own dedicated storage. And then it came with this mobile home park across the street that was mostly vacant. So we're currently running that as an RV park, but the long-term goal here is to fill those up with mobile homes as well. Eagle Valley Estates was the final park that we added to the Fund Two portfolio. Really nice quality asset. It's a 3-star all-age community in Carson City, Nevada. 180 lots there. Hidden Oasis Estates was the first direct investment that we brought out in 2024. Now, this was an infill project where the previous owner just ran out of energy. It is about 50% vacant, and it'll take 3-4 years to reposition that park. Country Glen Estates is a little bit more of a operational play, but this also is unique because we intend to keep this long-term as a legacy asset. So is a direct investment again with just a handful of investors exposed to it, but the goal here is to do a refinance, return capital, and keep this asset as more of a legacy asset. Let's walk through a little show and tell how we like to reposition properties. So this photo that you see right here, this is a kind of a classic vacant lot. You see the utilities here in the back, and then you see a sidewalk here that would lead up to the steps that would go to the front entrance. On the right over here is the driveway that would be covered parking. Most of the time when we purchase a park, it comes with vacant or old mobile homes in all states and condition. And I'll just flash through some photos here so that you can see. This is probably a mid-80s vintage mobile home. We got these and we bring them down to the studs and start all over again. So our intention is to have a really nice, functional, high quality home, even though it might be of older vintage, so that we can attract really high quality tenants. At the end of the day, mobile home tenants tend to make permanent housing decisions, and we'd like to attract really high quality tenants from the outset. So to do that, make sure that you have a finished product that looks like this. So even though this is an 80s vintage home, if you fix it up right, you can offer that for sale for less than you could if you brought in a brand new one. Some interior photos of completed renovation projects that we've done. This exterior, this is probably a late 70s, early 80s model. It was all metal siding and kind of an ugly looking old home. But it's if you spend the right energy on it and take the right strategy, you can end up with a product that looks really nice inside and out. Here's another one. Even though this is an old home, it presents really well. The interior looks really nice. So we like to focus on higher quality markets, higher quality assets, and do higher quality work so that we can end up with a higher quality tenant base. We also bring in new homes, both double wides and single wides, and we do everything soup to nuts. So you'll see here brand new sidewalks, new stairs, new awnings, new driveways, new air conditioning, everything is brand new. Here's some more photos. Here's an entire street that we repositioned, or some of these you can see are still in the process of repositioning. And then I'll wrap up with the RV strategy. So in many cases, when there's vacancy in a mobile home park, the lots are substantially larger than they are in an RV park. So in the process of converting to full occupancy, you can use a blended strategy where temporary income comes from RVs, and it's a lot easier to rent an RV space when you're competing with tiny RV spaces in the marketplace. So if you see this space, you could bring a boat and a truck and a motorcycle and an RV and fit it all in one space. So part of our reposition strategy is the use of temporary income from RVs. Okay, let's walk through the offering types you can expect to see from us here at 5210. Historically, we have had fund investments, so you'll see some of the content on our site referring to Fund 1 and Fund 2. But currently, we only have direct offerings on the equity side, and then we expect to come out with a private credit offering in the latter end of 2025 or early 2026. So let's walk through each of those. Direct offerings is a investment in a single mobile home park. We target 14 to 18% IRRs to the LPs. That's net of fees. Cash on cash stabilized is going to end up somewhere in the 6 to 10% range, and that's going to vary from property to property. We underwrite to a 7-year initial term that will hold it, but then our intention with these direct offerings is that we want to hold these indefinitely thereafter. $100,000 minimums, and for larger check writers, there are greater economics. So if you see down here on the bottom left, 100,000 gives you a 60-40 split of everything over the pref hurdle. $300,000 check gets you a 70-30 split over the pref hurdle, and $1 million check gets you an 80-20 split over the pref hurdle. Cash flow is distributed every 90 days via direct deposit. We do take bonus depreciation. So one of the most powerful things in these direct offerings is a small group of investors are going to share at least dollar for dollar passive losses on their K1. And then it is our intent to hold these properties long-term, refinance, return capital, avoid the tax events, and keep the coupon indefinitely. So that's what our direct offerings look like in general. And the private credit offering, this is essentially going to be allow us to provide chattel financing for the residents who purchase homes in the communities that we own and manage. So the debt fund will raise capital from private investors. We'll offer chattel financing to our residents who purchase homes, and the monthly payments that they pay to us will be passed on to the investors in the fund. So again, this is something that is not available yet, but we expect to come out with this in the end of 2025 or early 2026. Let's walk through the powerful tax benefits that are afforded to mobile home park investors. Before we get started, this is just a demonstration. This is not tax advice. So certainly consult your tax professional before you make an investment just based on the tax benefits. So we're going to walk through a general example here. This is just for illustration purposes only. The goal is to demonstrate why mobile home parks are so tax efficient and why investors love the passive losses they receive on their K1s. So generally, when you purchase a property, its value is divided up into 3 buckets. On the left-hand side here is the land. You cannot depreciate land. Land can fall anywhere from 10% to 30% of the property's value, depending on where it's located in a market. But for this illustration, we're going to get conservative here, and let's call it 30% of the property's value cannot be depreciated. In the middle there, you have the buildings. So in a typical residential or commercial building, those are depreciated on a straight line schedule of over 27 and a half years or 39 years, depending on whether it's residential or commercial. This will usually represent about 60% of the property's value for most real estate or most commercial real estate. But for mobile home parks, it only represents 10%. So the commercial building in a mobile home park is going to be like the office or the clubhouse. It's just a small portion of the value of the property. It's just a single building. And then on the right-hand side there, you have land improvements. Land improvements are depreciated on a 15-year schedule, and this is where the power shows up, and I'll show you on the next slide. Typically, land improvements are about 10% of the property's value for most commercial real estate, but they're 60% for mobile home parks. So land improvements in a mobile home park are going to be all of the pipes underground, all of the underground infrastructure. It's going to be the roads in the entire property. It's going to be the individual pads and pedestals and utility connections, the fencing, the landscaping, the lighting, everything in the pool and everything that except for the building is considered land improvements. And most of a mobile home park's value is made up of land improvements. So now let's walk through a $10 million example, and let's just compare most commercial real estate to mobile home parks. So on the left, you see that land cannot be depreciated. We're going to use 30% for this example, so that's $3 million. In the middle here, you have the building, which is going to be depreciated on a 27 and a half or 39-year schedule. This is going to be $6 million worth of value for most real estate. But again, for the mobile home park, it's only $1 million worth of value. So it's only 10% of the value. On the right-hand side, this is where you get to take bonus depreciation. So any portion of a property's value that falls with a useful life of 20 years or less, which land improvements are 15, you can take bonus depreciation in the calendar year that the property is purchased. So that all contributes to the passive losses on the K1. This is about $1 million for most real estate types, but for mobile home parks, it's $6 million. So this is where that opposite effect comes in. Let's look at this comparison in real time as it relates to coverage on your K1. So for most real estate, the $10 million purchase, they would get $6 million worth of straight line depreciation that they can take over many years. And they're going to get $1 million worth of bonus depreciation that they can take in the calendar year the property was purchased. So if you put $3.5 million down, you'd get about 28% coverage, which means for every dollar invested, you'd get about 28 cents of passive losses on your K1. The mobile home example on the right, same $10 million purchase would give you $1 million of straight line depreciation. And again, that's for like the clubhouse or the office. But it gives you $6 million of bonus depreciation that we can take in the calendar year that the property was purchased. So if we put $3.5 million down, but you get $6 million worth of losses, there's more potential loss available per dollar than there was dollars invested. So in this example, you'd get 170% coverage for each dollar invested. So for every dollar you invest, you would get a $1.70 in passive losses. Now, that's not going to apply on every property. It has to do with the qualified debt. So if we were using agency debt, that would be the case. But even with a seller finance loan, you'd still be able to achieve dollar for dollar. So worst case scenario, you invest $1, you get $1 of passive losses. So again, this is a general demonstration to show why mobile home parks are so favored by investors who are seeking passive losses. Let's conclude today's presentation with a brief summary of mobile home parks, and then we'll talk about next steps. So first of all, mobile home parks are a lower risk profile, and they have recession-resistant qualities that allow them to continue to perform even in the worst economic conditions. This gives us the opportunity for high cash flow and high returns when things are great, but even when things are not so great, it allows us stable cash flow and that continued demand that allows the strategy to always be executed regardless of what's going on in the world around us. They come with the potential for significant tax benefits. So if you'd like to gain exposure to mobile home park and related investments with an experienced operator, next steps is to go to our website at 5210.com. When you get there, go to the contact page and you'll see a form that looks like this. Fill out that form and you'll get a response from me. That'll give you an opportunity to schedule a phone call directly on my calendar where we can answer all of your questions. We can talk more about the tax. I can share what's coming in the pipeline and we can evaluate timing. And then the last thing I'll share here is that you can save your spot in line. So one of the things that you'll find unique about 5210 is our offerings go pretty quick to our private network of investors. So we give first right of refusal to those who raise their hand and reserve a spot in line before we go out to the general public. So thank you for spending time with me today around mobile home parks. Go ahead and schedule a phone call with me, and I look forward to speaking with you soon.